for the total report, do we need to have a group list of the company to say recommendation, buy or sell? Okay.
So it'll be the front 2 pages will just be a summary of all your companies.
Actually, before we send out the market regression, I downloaded some market data to run my own regression. So it's better I redo it to use your market. Okay.
Okay. So we're down to counting the last few classes. There are 4 more to go, right? 2 this week and 2 next week. Yesterday I sent you that to-do list on your project, so just go check. If you've done your DCF, there's not much left to do. It looks like a lot of stuff, but there's actually not much left to do. Just get it done. The quicker you can get it done, the better. One final thing, and I did send this in my email, the to-do list, but I just want to remind you that while the project itself is not due till 5 p.m. next Wednesday, the 14th, I'd like to get your summaries of what your final numbers look like. Just a spreadsheet. You say my DCF value, my pricing, and just send it to me by Tuesday night, because on Wednesday I will try to get all of your recommendations and show them back to you. Now, basically, we can look at what percentage came out undervalued, overvalued, how many buys, how many sells, etc. But I need that by Tuesday night for obvious reasons. Otherwise, I can't get it together by Wednesday. So if you get it done well before Tuesday night, you don't have to hold out till Tuesday night. It helps me if you can send it on Monday or Tuesday afternoon or Tuesday midday. It actually is a little easier for me rather than getting 250 summaries at 7 p.m. or 8 p.m. One final thing, as you work on the pricing for your companies, and I've said this before with your mystery project, don't fight the data. You know what I mean by don't fight the data? You can run a regression. If the regression doesn't work, you can't make it work. So wrestling with it and playing with it is not going to make it. And here's what you have to think about. You control how much you use your pricing. So you can use a pricing. You also have a DCF, and what's the final judgment I ask you to make? Would you buy or sell? You get to decide what you're going to base that recommendation on. So if you look at the pricing and it's very noisy, same thing as saying, you're getting a huge range in your numbers, you don't feel very comfortable with it, just don't wait in your final judgment. Say, look, I did the pricing and this is what I get. I don't think that that is a reasonable way to put a number on my company. Yeah. And one final thing, if you're doing a very young company, when you start putting today's numbers into regressions, whether it's a market regression or a sector regression, you will get strange numbers. And there's an obvious reason why. You take today's revenues and today's earnings for Snap. You put into regression, you're going to get weird stuff. Okay? That is to be expected. There is one simple way you can get around that. If you really want to price a Snap, here's what you need to do. If you've done a DCF of Snap, and of course nobody's valuing Snap because it's not public yet, but if Snap-like company, remember in your DCF, your projected revenues in year 5 or 10, just go to your DCF, pull those numbers out, build your pricing around year 5 or year 10 numbers, and then your pricing will have some more substance to it. Of course, it's only as good as your forecasted revenues in year 5, but that goes without saying anyway. So today I want to complete the discussion of real options, and I want to start off by presenting you a what if. Okay? This builds off the very last thing we did last session, where we talked about the option to delay and applying it to valuing undeveloped reserves. Let's suppose I showed you two companies, and this in fact is no longer true, but at one point in time it was true. I showed you Royal Dutch and Petrobras, and let's assume that the estimated value that I get for both companies today, and let's say today's oil price is $60, is exactly the same. But here's the difference. Royal Dutch gets 90% of its value from existing reserves, developed oil coming out of the ground. Petrobras gets much of its value from undeveloped reserves. So the two companies have exactly the same value. The oil price today is $60 a barrel. But one company gets a bulk of its value from developed reserves and oil coming out of the ground. The other company gets value from undeveloped reserves. Let's suppose tomorrow you wake up to a crisis in the Middle East. Whatever country, Iran, Iraq, Saudi Arabia, somebody has a problem. Oil prices go from $60 to $100 per barrel. Now this is the easy part of the question, so help me out here. If oil prices go from $60 to $100 per barrel, what will happen to the values of the two companies? It's the easy one. They'll both go up, right? So they'll both go up because oil prices have gone up. Big deal. What's the puzzle here? Let's say day after tomorrow the crisis goes away. The price drops back to 60. So what it was when you first did the valuation. And here's where I want you to think about the answer. So yesterday when the oil price jumped to 100, both companies jumped. Now it's back to 60. Will the two companies go back to what they were worth day before yesterday? Or will one of the two companies be worth more after this crisis and uncrisis happens? If it's going to be the latter, which company is going to be worth more after this whole process? Greg, you want to try? And why?
Because more of their value comes from an option which is increased in value by the volatility.
And what happened over the 2 days? We tend to forget this. Volatility is always a perception, right? We can use implied variance, we can look at historical variance, but it's in the minds of the market. You have a crisis like that. Price jumps and goes back down. The market says, oh my God, I hadn't thought about this happening, so I'm going to build in a higher expected volatility. Undeveloped reserves are options. The value of those reserves will now go up as options. It's actually a very interesting phenomenon because often when you talk to oil analysts, they talk about the level of oil prices. And that does matter. But they don't talk about the volatility in oil prices, which also should matter. I mean, I remember valuing oil companies in the late 1980s, and the oil companies were dead in the water for two reasons. Oil prices had come down to $18, $20 a barrel, and they were very stable. If oil prices are down and stable, it's a double whammy because not only is the price down, therefore the value of your oil is down, but with the variance being down, the value of your undeveloped reserves is also down. So the next time you see a news story about oil, and oil's been in the news for the last 5 or 6 days, think about not just the level, but the variance in oil prices and how it's going to play out with different oil companies. Any questions on that option? Okay. Now, if you think about the undeveloped reserves as an option, it is the closest you get to your ideal real option. Think of why. There is an option, obviously, under the ground. There's a contingent payoff. If oil prices go up, the oil gets to be taken out. There's also exclusivity. Where does the exclusivity come from for undeveloped reserves? There's only so much oil under the ground. If oil prices go to $200 a barrel, you and I can't go dig in our backyards. We could, I guess, saying, I'm going to go look for oil. So because you have a scarce resource, there's an optionality. And I want to draw a tangent from that. Let's say you're in real estate in Manhattan. Right? Manhattan is the most heavily zoned building area of all of New York City, perhaps in the country. In terms of every square inch of ground in Manhattan is spoken for already. Okay. In what sense? I mean, even NYU, when it builds buildings, has to think about how much square footage. In fact, when we built this building, we had to knock off the top 2 floors. Originally, it was supposed to be 13 floors. The only reason we have 11 is not because 13 was an unlucky number, but it turned out that NYU had borrowed the space. Don't even ask me how this works. That was supposed to be on this land and used it to build Kohl's, the old rec center. So they wouldn't let us build the extra 2 floors. You see where this is going? Let's suppose I come to you with a 3-story building in Manhattan. Let's say it's 30,000 square feet. And the price per square foot is, let's say, $150 per square foot. You're saying, this is easy, 30,000 times 150. But let's suppose this 3-floor building is in a space where you can have 8 floors. You see where the optionality is going to kick in? You're going to value the building, and then you're going to say, look, I have the right to add an extra 5 floors. Right now, it doesn't make sense. The housing market is not tight enough. But because I have that option, I'm going to be willing to pay a premium. Every single real estate transaction in Manhattan probably has an option premium, small or large. And you could think about what that premium is worth and why it is specific to Manhattan. If you're buying a building in Kansas City, please don't pay an option premium on that building. If you want to grow, you just keep growing. There's nothing to stop you. It's like being in Vegas. Every time you go to the city, it just gets, spreads out further and further. So when you're in tightly zoned areas, again, the same scarce resource argument gives you the optionality. So what I'd like to do now is go back and talk about the other 2 options in capital budgeting. And the first of these is the option that excites the most people. It's called the option to expand. Let me describe how this works. Let's suppose I come to you with a project, and the project by itself has a negative net present value. We agree that this is taken today, this project will destroy value rather than add it. But let's assume that if you take this project and you get good outcomes, you have the option to expand the project. The very simplistic example I would offer you is of a hotel company that opens 10 hotels in China. And let's say that based on what you know today, you're going to lose value on those 10 hotels. But if those hotels do well, you have the option to open 100 more hotels. It's a big market. You could argue that the option to expand can have so much value that you will take the first project even though it's a negative net present value project. Let me draw this out as a payoff diagram again so you can see what the underlying asset is. So basically, there are 2 projects here that are connected at the hip. You have to take the first project to get to the second one. The first project is a negative net present value project. It's that second project, the option to expand, that becomes the option you're trying to value. However much you have to invest to expand becomes the strike price. You can choose to expand, you can choose not to expand. You'll of course expand only if you think the present value of the cash flows from expansion exceed that strike price. And if that never happens, what do you lose? What did I tell you about the first project you took? Negative net present value. You write off that negative net present value and say, I wish I hadn't taken that project. So let me give you a very simple example of how this plays out in valuation. Let's suppose I come to you with a company, in this case, a small antivirus software company. You do a traditional discounted cash flow valuation. You come up with a value of $115 million. You're done, right? You got a value for the company. But let's say I now add a layer of uncertainty. Let's say as this company operates, it is going to accumulate a database. Database of companies, database of people who supply the viruses. Basically, it's acquiring a database in the course of doing business. And any time over the next 5 years, it can choose to create a database program to take advantage of the data it's accumulated. It'll cost it $500 million to go into the database market. And right now, based on what it knows about the market, it thinks it can make only about $40 million a year each year in after-tax cash flows for 10 years. Let's stop right there. It'll cost $500 million to enter the market. You make $40 million a year for the next 10 years. I've already told you this is a bad project, right? Because even without discounting, the total cash flows is 400 million. But it's pretty risky. So the cost of capital for database software companies is 12%, so you'd have to discount the 40 million back to today. The standard deviation in firm value are other database companies 50%, which basically means there's a lot that can happen in this business you can't forecast. It's a very risky business. And finally, the risk-free rate for the 5-year T-bond is 3%. Let's see how this works out as an option. Okay? The present value of 40 million a year, every year for the next 10 years, at the cost of capital of 12% is 226 million. So that's the present value of the cash flows based on what you know today. The cost of entering the market is $500 million. It would be crazy for you to enter the market today because this is an out-of-the-money option. Your redeeming grace, though, is the standard deviation in value is 50%. There's lots you don't know about this market. Ignorance actually works as a plus here because it's making the option more valuable. Riskless rate of 3%, 5-year option, the value that I get for the call is 56 million. You're saying, what have I just valued? Basically, what I valued is the option for this company to expand building on a proprietary database. And the key word is that proprietary database, which means the value I would attach to the company is the 115 million that I get from the DCF plus the 56 million for the optionality. Now, if this sounds too artificial, think about a social media company, right? Take Facebook. I ask you to value the company, you tell a story about it being an online advertising company, a very successful online advertising company, you come up with a value of 150 billion. Where's the option to expand here? What's Facebook's biggest competitive advantage? They have 1.7 billion users who are on Facebook all of the time. Right now, all they're doing is supplying advertising because they can't figure out any other way to make money off them. Retailing, they will probably lose money today, but they have those 1.7 billion people as their user base. Is it possible that Facebook could come up with new ways of making money of the 1.7 billion? Yeah, you might not be able to build. In fact, it's not that you don't have foresight, but right now it doesn't make sense for them to do it, so you haven't built into your expected cash flows. But if the stars align, that 1.7 billion user base could be used to add to the value of the company, which means that if you have a DCF value of 150 billion, there's going to be an option value that's pretty substantial. The way this plays out in a decision process is I bought Twitter, a decision I still regret, at fair value. So the DCF value, I think when I bought it was like 24, it was at 24, and I said, you know what? And usually you don't buy something at fair value, but my justification is that fair value was just the DCF value, that if this company could ever figure out a way to take its 310 million users and do something significant economically with them, there should be an option premium. Of course, it hasn't played out, but that's the way it'll show up in your decision process. And guess what? When Snap goes public and you do a DCF of Snap, you're getting a baseline value. There is going to be an optionality here that you've not captured. So this is why people love option to expand, because it means you can override traditional DCF and do whatever you wanted. So I'm going to add a constraint. If you decide to go this route, you need to ask some questions. First, you have to ask, do I need to take the first investment to get to the second? Remember, I've locked up 2 investments, right? First bad project to get to the second. And second, and this is the key one, is how much exclusivity does this company have? In that secure mail example where I gave that database example, if you are pushing back, you're saying, what's so special about this database that you're building up? What are you learning that other companies are not learning? And if I can't come up with a good reason, you shouldn't add the 56 million. With Facebook, when I use an option argument, say you should buy Facebook, you should push back. And in this case, I'm probably on fairly solid ground saying 1.7 billion users. Who else has it? And who else has the user intensity that Facebook does? Exclusivity, that key word is what's going to drive whether the option to expand should be on top of a DCF value. Any questions on the option to expand? Yes? See, first mover advantages to me mean you can't think of a good advantage. Because what are you saying? I was here first, right? Does Uber have a first mover advantage? I don't think that's its biggest advantage. The advantage for Uber is not that it came first, but that it might have the most drivers. So the first mover has to give you something significant. If you're in a business where there are networking benefits, being the first mover helps you. But it's not the first mover per se, it's a networking benefits. So I would say first mover is the first step in the argument. I'm looking for something more substantial. So that's why I think of it as a weak competitive advantage. At the other end, of course, a patent is a complete competitive advantage. So somewhere in that continuum, I'm going to think about where your company falls. Yeah. That's the weakest link, right? And in fact, you can see already when I make that argument, do you remember the example of the hotel? Let's give the hotel chain a name. Marriott opens 10 hotels. It says, look, if these hotels do well, I'm going to open 100 more. What's the weakest link in my argument? Yeah. What I'm going to do is I'm going to watch my 10 hotels to see if they do well, right? Who else is watching? Hilton, Holiday Inn. And if I'm doing well, just as I get ready to do the 100 more hotels, they all jump in, which means I do the dirty work for them of collecting the information and they jump in. And that's why opportunities are not options. That's why just because you're entering a big market, you can't use that as an excuse. And that's why for the last decade, I've been arguing that China is in fact the laziest argument you can make as a company. Because what do companies do when they invest in China? They say it's a big market, therefore, it doesn't matter how much you lose. Not enough. You have to show some exclusivity in that big market for it to actually make money for you. Any other questions about the option to expand? So let's pass these through the test. Is there an option? Yes. The option is the present value of the cash flows from expansion have to exceed the cost of expansion. So the contingent payoff exists. The underlying asset, though, is that second project, the expansion project. Is there an exclusivity? It varies. And this is where option to expand can range from no value to lots of value. So this is why you took that corporate strategy class, hopefully, right? So somewhere you thought it would be useful somewhere. This might be the place where you use it to say, hey, the one thing that I wish corporate strategy would give me is some way to measure the strength of a competitive advantage, right? So if you take the Porter 5, whatever, the 5 tests or whatever it is, I'd like a number. I'd like some way of saying this is a stronger barrier than this one, because that will allow me to bring it into the process. But here's the weakest link. I'm using an option pricing model to come up with that 56 million, right? The underlying asset here is the project, which is not traded. The option is not traded. So in a sense, I have neither replication nor arbitrage. So I'm really in no man's territory putting a number. And that's why when I valued Uber, I kind of waved my hands and said, there's probably an option here. I have no idea what it is or how much it's worth. But I do know it says. So it's a tough part is actually putting numbers on this because it's a pretty fuzzy option. Let's talk about the option to abandon. Almost every single option, real option is a call option. So when you talk about the option to expand, the option today, the option to abandon is the only put option in the real options literature. And here's how it works. When you have a project, let's suppose you have the right to abandon that project. And if you abandon that project, you're going to get X dollars. Of course, you will abandon the project only if the value of the cash flows falls below what you will get from abandoning the project. So if I gave you the option to abandon, I'm giving you a lower floor on how much you can lose. You're saying, what chance is there of ever having something like that? Let's take a simple example. Let's assume that you're Airbus and I'm Lear Aircraft. Lear Aircraft produces these little corporate jets. And I really want to enter the passenger airspace, so I come to you wanting a joint venture. So I say, look, this can be a joint venture, 50-50. You take 50%, I'll take 50%. And we can produce small passenger jets. You work through the cash flows as Airbus, and you come up with the present value of expected cash flows of 480 million, and your 50% is going to cost you $500 million. So already what have I told you? If you take this project, your net present value is going to be minus 20 million. So you say, no, but I really want you as a partner. So I come back to you with a counteroffer. I say, look, if you decide to become my joint venture partner, I will give you the option to walk away any time over the next 5 years and pay you 400 million, less than what you've invested, but I'm putting a floor on how much you can lose. See the put option I've given you? As long as the present value of the cash flows exceed the 400 million, you'll stay my partner. But if they drop below 400 million, you're going to come back to me with your 50%, I have to pay you 400 million. The project itself is a 30-year project. Why did I give you the option to abandon only for the first 5 years? If I gave you the option over the entire 30-year period, what are you going to do? You're going to be my partner for 29 years and 364 days. And the very last day, you say, I never wanted to be a joint venture partner. Can I? So be careful if you give the option to abandon that it doesn't last the entire lifetime of the project. Let's see what the value of this option to abandon is. And what does it have to exceed for you to even consider joining this project? Your net present value was minus 20, so you want to see if the put option is worth more than 20 million, because at least then you might be tempted. So here's what I did. The present value of the cash flows today. Any time, you'll notice with all the real options or regular options, S is always the present value as if you did this today. It's 480 million. The strike price is 400 million. That's your abandonment value. The variance in asset value is 0.16. That's a 40% squared. So there's an uncertainty about the cash flows. However, this is a finite life project. So every year the project is going to get less valuable. It's going to become 29, 28, 27. So there's an equivalent of a cost of delay. You have the right to abandon for the next 5 years. And the risk-free rate over that period is 6%. So I have all the parameters I need for option pricing. I plug it in. The value that I get for the put option is 73.23 million. So the net present value minus 20 million, I'm offsetting now. Doesn't guarantee that you'll be my joint venture partner, but you can already see that if I give you protection against downside, you're more likely to step in and become my joint venture partner. The option to abandon is just another way of saying you like to build in flexibility into your big investments, right? So if you're a company making a big investment and you can build in flexibility into that investment, it's better for you. Build in escape hatches. It's not a sign of weakness. If you're building a $10 billion plan, it's nice to preserve the option of saying, I want to be able to step away from this. I'll pay you $2 billion if need be to step away, but I'd like that option to abandon. And recently, I think I talked about this a few sessions ago, Conoco entered into this natural gas oil plant in Australia, huge $35 billion investment. And it did it in 2010 when oil prices were $100 per barrel. It looked good then. The plant was finally completed last year. I mean, I'm sure Conoco wished it had built in an option to abandon, to walk away from that investment, but it did not. So when you hear about flexibility and the value of flexibility, one of the aspects where it's going to show up is in your capacity to walk away from big investments if things change. Any questions on the option to abandon? So actually a good option to have in personal lives as well, right? Right, so preserve the option to abandon no matter what you do. So don't take this too literally, but when you take that job offer, build in an escape hatch. Don't say, I'm going to show people how committed I am by locking in my life as if this is going to be my job for the rest of life. Don't be crazy. In this world, having the option to abandon will always give you a way of escaping from something if it doesn't work out for you. Which brings me to options and capital structure. I'm going to take you back to traditional corporate finance, right, where we talked about optimal debt ratios for companies. Many of you were in my class, you computed the optimal debt ratio for your company, and I'll summarize what you found collectively. I think out of the 300 companies in the class, 80% came out as under-levered. What does under-levered mean? The debt ratio they were at was lower than their optimal, with the optimal having a cost of capital lower than the current debt ratio. Companies were preserving excess debt capacity. I'm going to actually argue that that excess debt capacity that you preserve is an option that you can use in case you need to buy another company, take a big investment, that once-in-a-lifetime investment. The options I'm not going to talk about in capital structure are the options of value conversion option or convertible bond, because those presumably you deal with in a fixed income class, so that's not my area where I want to go into. I want to talk about that other option, the option of staying below your optimal because you want to preserve excess debt capacity. So here's what I want to talk about. I call this financial flexibility. Essentially what you have is an optimal debt ratio. You've left yourself below it knowing fully well you have excess debt capacity. And the reason you want excess debt capacity is just in case you need it. Why? Because there might be an economic downturn. That excess debt capacity is nice to have. A great project comes along. That excess debt capacity is nice to have. So let's make this specific. I'm going to show you a table from way back, 1997, when I looked at the optimal debt ratio, my first edition of my applied corporate finance book at Disney. Its actual debt ratio was 18% and its cost of capital was 12.22% at that actual. Its optimal debt ratio was 40%, the cost of capital was 11.64%. So it's at 18%, it could be at 40. And by being at 18%, its cost of capital is 54 basis points higher than it could be at the optimal, right? So in a sense, each year, they're giving up 0.54%. That sounds like an absurd thing to do. Let's suppose Disney's response is we're holding back that debt capacity. They don't even argue that the optimal is 40. They say, look, I know we can be at 40 with a lower cost of capital, but we're holding that excess debt capacity just in case a project comes along. So let's draw the payoff diagram and what this is going to look like. Basically, if you think about how much you can reinvest every year, let's suppose you're constrained. Constrained either because of external constraints about how much capital you can raise or internal constraints like we don't want to issue shares. There's a certain amount of reinvestment you can fund without drawing on external capital. Let's assume you get that amazing investment, a huge investment and acquisition you can do today. You can buy Twitter. You can't buy it with your normal financing because you don't have enough. But let's say if you have excess debt capacity, you can draw on it to take that once-in-a-lifetime project. See what the payoff is? To the extent that that project has positive net present values, you've essentially been able to take advantage of it because you had excess debt capacity. And I'm going to try to measure what that's creating for US value and compare it to the 54 basis points you're leaving on the table by being under-levered. But built into this entire option is the presumption that capital is constrained. Now do you see why in traditional corporate finance this option is worth nothing? Because if we assume that you can always raise as much capital as you want, whenever you want at the drop of a hat, you don't need excess debt capacity. But the minute I introduce constraints, you can start talking about why you might be under-levered. And the stronger the constraints become, the more under-levered you'll become because the value of the option will go up. So the question is, can you actually value this option so that you can compare to the 54 basis points? I don't know whether you can, but I'm going to try. So here's what I did. I need inputs to the model, right? So I went through each input, trying to come up with an annual cost of how much this option is creating for me as value. The S in this case is my reinvestment needs each year on an annual basis. What is reinvestment? Net capex plus change in working capital. So I took that as a percent of value every year for the last 5 years, and the average of that number was 5.3%. What does that mean? In a typical year, what Disney reinvests is about 5.3% of its value. But there's a lot of ups and downs. If you look at the standard deviation of that value, it's 0.375, which means there are big years, up years, big down years. So the reinvestment goes from 17% to minus 2%. So it's not 5.3% fixed. It's varying across time. In fact, during this time period, one reason the standard deviation was so high is in one of those years, Disney bought Cap Cities, which was a big acquisition. So companies that do a lot of acquisitions will have more uncertain reinvestment needs. The K, which is the key number here, is how much they can reinvest without drawing on external capital. So what I did was I looked at the free cash flow to equity and what they normally borrow, and that was about 4.8% of firm value every year for the last 5 years. So I made that my K. And I computed the value of the option over a single year period because then I can compare it to the 54 basis points that I have as what I'm paying to get this flexibility. So here's what the numbers look like. If you look at valuing it as an option with those inputs, I get 1.6092%, or 1.61% if you want to round up, as the value of my options. But that is the option to take a project. However, project creates value only if I earn a positive net present value, right? If I earn more than my cost of capital. At the time that I did this, Disney was earning an 18.69% return on capital on its projects, and its cost of capital was 12.22%. So basically it was earning about 6.5% more than its cost of capital. I'm going to make a leap of faith. I'm going to assume that the new project they can take with the excess debt capacity will continue to make those excess returns. What I get as a value for my option is 0.85%. And here's how I read it. By preserving the excess debt capacity, Disney now has the option to take these projects. That option is worth about 85 basis points a year. And to get that option, they're giving up 54 basis points a year. The net effect of being under-levered here is actually adding value for me as a stockholder So I'm not going to push Disney to go to its optimal because I gain more by leaving it under-levered. It's a torturous argument to get to because you've got to build on all these constraints, but I think it actually explains why so many companies stay under-levered. Is whether it's true or not, they believe they're capital constrained. I've talked to S&P 500 companies which should be able to go out and raise capital at the drop of a hat, right? But because they don't like to issue new shares, they have the dilution constraint, they have constraints. And the minute you put in constraints, there is a value to financial flexibility. You probably don't want to try to put a number on this for most companies, but the implications of viewing this as an option are actually the most interesting things that come out of this. So here's the first one. The greater the capital constraint you face as a company, the greater the value of financial flexibility as an option. So I would expect small companies to be more under-levered than large companies. Why? Because small companies face more capital constraints. I would expect emerging market companies to value financial flexibility more than developed market companies. I would expect emerging market companies to borrow less, to be more under-levered than. I would expect companies during a crisis to value financial flexibility more than companies in good times. But here's the follow-up. The value of that flexibility comes from two other factors. The first is how unpredictable are your reinvestment needs. If you're a company that knows exactly what you need to reinvest every year for the next 10 years, you're a toll road construction company, your plans are already set on paper, there is no value to flexibility. You know, the more uncertain your reinvestment needs become, you're in a business where things can happen unpredictably, you should value financial flexibility more than if you're in a business where you cannot do that. I would expect tech companies to value financial flexibility a lot more than steel companies, which means I would expect tech companies to be far more under-levered than steel companies. But all of this rides on what? That the projects you take earn more than your cost of capital, right? So if you're in a sector where you have trouble making your cost of capital, please don't talk to me about the value of financial flexibility in your sector. I don't want GM and Ford to be under-levered just in case. Because I've seen what happens when that just in case comes along, because when they do that big acquisition or investment, I'm far more likely to lose money than make money. So in sectors where excess returns are high, I would expect financial flexibility to be worth more. So look at capital constraints, look at how unpredictable the reinvestment needs are, and look also at your capacity to earn excess returns. Those are the things that drive how much value you'd attach to financial flexibility. So if you get a chance, go back and look at your corporate finance. If you did this with me, go back and look at your company and how under-levered it was. And then ask yourself, if I were looking at this company through the lens of financial flexibility as an option, would I cut some slack? And maybe if it's a small tech company, and it could be at a 20% debt ratio, it chose not to borrow money, you might say, you know what, that's okay. The value of financial flexibility here is going to be large enough that I'm okay staying below my optimal. In fact, over the last 8 years, as the world has become a more uncertain place, I've argued that companies have to be a lot more cautious about jumping to their optimals, because the value of financial flexibility has, in a sense, increased across the board. Any questions on it? In fact, if you're an emerging market company in a really, really tightly capital constrained environment, not only will you stay under-levered, but so your debt ratio, instead of being 40%, might be 20, might be 10, might be 0. Could it be below 0? If you really worry about capital constraints, we talked about this in the context of cash, what are you going to do? You're going to start accumulating cash. Your net debt ratio can actually become negative because you're saying, look, I need the cash just in case, because the entire capital market can shut down. That Argentine company that had cash that we attached a premium to, that premium is an option premium. Michelle?
Do you ever consider if your firm is over-levered, a potential put option if they've been able to renegotiate their debt?
That's going to be the next option, right? In fact, I'm going to argue that the equity in that company starts to behave more and more like an option. Now, I buy my shares in Valiant. I'm not sure whether I'm buying a common stock or an option anymore. And you're going to see this happen. You're wearing Bombardier, right? That's more option than common stock. This is a basket case company. The value of its operating, your DCF, you found the value of the operating assets was less than the debt. You're saying, this is absurd. Why would I buy the stock? For the same reasons you buy a deep out of the money option. What do you hope? That something good will happen, that the value of the assets will climb, or the government will bail you out, or something will happen that will make the value exceed the equity. So that's going to be the last piece of this options puzzle. Yes?
When investing, do you assign option value to holding cash in case there's an option that runs in a
I'd be discriminating. So let's say you hold cash and you say, give me an option value. First question I'm going to ask you is, are you capital constrained? And you're going to say, yes, of course I'm capital constrained. And then say, tell me why. So because I don't like to issue shares. That's a much weaker capital constraint than the banks have shut down and I can't raise equity, right? So if you're a private company and you say you're capital constrained, I understand. So second question I'm going to ask you is, can you predict your reinvestment needs fairly well? And you say, look, I'm in a risky business, all kinds of strange things can happen. And then I'm going to ask you, what kind of returns have you made on your past projects? And if you say, I've barely broken even in terms of my cost of capital, I'm going to say, look, I'm not going to give you the value. So it really depends on whether the stars line up, whether you're a small company with capital constraints, with unpredictable reinvestment needs, and positive excess returns. Then I'm going to say, I'll attach an option value to your cash. Okay. Even if it means not putting a specific number, I'm at least going to cut you some slack on that cash and not punish you for holding cash. Yeah. Any other questions? So now let's talk about valuing equity as an option. So here's what I'm going to do. I'm going to make you guys equity investors, the rest of you lenders. They're going to have the fun part of this. You're basically going to just hold the reins, hoping that nothing bad happens to you. Okay? And here's what makes equity an option. As equity investors in a publicly traded company, you get to run the company, right? You get to run the company. You choose to liquidate the company. That's your choice. Equity investors in a publicly traded company have the right to run the company and liquidate the company. If you liquidate the company, you get a cash flow from liquidation. And what's the first thing you need to do with those cash flows? You need to pay off the debt. And if there's any cash left over, you get to keep the difference. But let's suppose that when you liquidate, the value of the assets that you get is actually less than the debt. What happens then? You pay off the debt, and you're done. You're done because you have limited liability. So the two things that make equity an option are the fact that you have a residual claim. You get whatever's left over, and if the cash flows are not enough to meet the debt payments, you get to walk away. So if I were drawing this as an option, here's what it would look like. The face value of the debt, which is what you have to pay off in liquidation, becomes the strike price. The value of the firm in liquidation becomes the equivalent of the stock price. The value of the firm exceeds the face value, you get to liquidate the firm and keep the difference. If it's less than the face value, what you lose is what you originally paid for the equity. I can't come after your personal assets. So if I buy Bombardier shares today, and Bombardier liquidates and it doesn't have enough cash to meet its debt holders, they can't come after me for the extra $2, $5, $10 per share, because with limited liability, I'm done. It's one of those options where you don't know whether you should pull for it to succeed, but you see it happen all the time with distressed companies. So let's set up the process. Let's take a very simplistic example, and I'm going to milk this example for every conceivable implication I can. So let's assume that you as equity investors and lenders collectively have invested in a firm where the value of the firm, if it's liquidated today, is $100 million. For the moment, let's assume liquidation value and DCF give you the same value. We'll come back and talk about the divergence. So firm values are $100 million. You guys are the lenders. You've essentially lent money to the firm, but it's taken the form of one 10-year zero coupon bond. You're going to see very quickly why I had to make it a 10-year zero coupon bond with a face value of $80 million, which means you've lent money to the firm. For the next 9 years and 364 days, they have nothing to pay you, but at the end of the 10th year, they have to pay you $80 million. The 10-year bond rate is 10%, and this $100 million that you see here could go up and down. The standard deviation that value is 40%. I'm going to argue that with this minimalist information I've given you, because I haven't given you cash flows, betas, cost of capital, with this minimalist information, you should be able to tell me how much the equity they own is worth, and you should be able to tell me what interest rate you would charge on your debt. So you can't do DCF, obviously, right? So let's see how we do this. And I'm going to construct it as an option. So you guys get to run the firm. The firm right now is worth $100 million. You can liquidate the firm. And if you liquidate the firm, you got to pay $80 million. That becomes the strike price. You have 10 years to play the game. Now do you see why I made it a nice zero coupon bond? for the next 9 years and 364 days. You have absolutely no legal power to stop them. If this were a coupon bond, what's the additional constraint I introduce on the equity investors? Every 6 months they have to pay you interest, and if they don't pay you interest, the game ends. So if I have a coupon bond, it becomes a series of 20 options, one on top of the other. The option still holds, but it becomes a much more difficult option to value. So at least for the initial run, I'm going to assume it's a 10-year zero coupon bond, so the 10 years becomes the life of the option. The last day of the 10th year, the power shifts back to the lender. So for the next 10 years, you have an option. The variance is the 0.4 squared, which is 0.16, and the riskless rate is 10%. I have all 5 inputs I need to value the equity in this company as an option. So I plug the numbers in D1, D2, N of D1, N of D2. Somebody remind me again what N of D2 measures? What is this 63% telling me? There's a 63% chance of what? S will be greater than K, right? What's S here? The value of the assets. K is the face value of the debt. There's a 63% chance the value of the assets will be greater than the face value of the debt, which means there's a 37% chance of bankruptcy. In fact, there is an outfit on the West Coast called KMV. Banks take their loan portfolios to KMV, and KMV estimates a probability of default for these loans. It charges a hefty fee for doing it. What KMV does is it puts it through an option pricing model, comes up with an ND2, just like we did, and takes 1 minus ND2 and say, there's a 26% chance your loan portfolio could fail. It essentially is an interesting way of reading an option pricing model as a way of estimating probabilities. In fact, I reviewed a paper once that actually compared this probability of default with the one that you get by looking at a S&P or a Moody's rating. And the paper contended that this approach gave a better judgment or a better estimate of the probability of default than using a triple B rating or a double B rating or a single B rating to get there. If I carry that through, the value that I get for the call, which in this case is the value of the equity, is 75.94 million. So your equity is worth 75.94 million viewed as a call option, which means that the rest belongs to you. 100 minus 75.94 is 24.06 million. Face value of the bond is 80 million. You valued it at 24.06 million. I can back out then what the interest rate would have to be. It's a zero coupon bond. And the interest rate I get on this bond is 12.77%, which is, if the risk-free rate was 10%, that's a 2.77% default spread. So I valued the equity as a call option on the firm. The option we're valuing is an option to liquidate. So keep that in mind, because we're going to come back and talk about why this shouldn't be done for every firm and why you might not bother doing this when you're valuing a Microsoft or an Apple or a Google. But there is an option to liquidate here, and that option to liquidate gives you a value for the equity of 75.94 million. Any questions on the mechanics here? Okay. So now let's add a layer of uncertainty. So the first thing I want to talk about is what happens to the two of you as I start doing bad things to your company. So let's suppose tomorrow you wake up and you read a headline. Half your company has disappeared. There are 2 factories, one in Florida, one in California. You take your pick. Hurricane or earthquake, one's gone. Not insured. The value of your firm has dropped to 50 million. Good news or bad news for you guys? Unless you have a very perverse definition of good news, this is bad news. So obviously the value of your equity will drop. But I have a very simple mechanical question. The value of the firm has dropped by 50 million. The equity used to be worth 75.94 before this bad thing happened, right? My question is, how much will the value of equity drop? And I'll give you the 3 choices. The first is, it could drop to 25.94 million, exactly 50 million, because the value of the firm dropped by 50. It could drop by less than 50 million, in which case somebody else has to bear the rest of the loss. Or it could drop by more than 50 million because your accountant freaks out and comes up with a negative book equity or whatever he does. Let's rule out what the accountant does. Who cares whether he freaks out or not, right? So let's pick the 2 possible choices. Equity could drop by 50 million. Equity could drop by less than 50 million. What did I say? If it drops by less than 50 million, somebody else has to bear this pain with you, right? Who's the only other player left in this game that you're going to drag into this game? You're going to go to the bank and say, come on. Would you like to share the pain? And what does the bank say? No, thank you. It's not a choice, because remember, you lent money to the firm. Now it's become a riskier firm. Your debt will lose value. So let's see how much value you lose. So remember 75.94, 24.06 before. If I plug in the new numbers, here's what it looks like. Everything else in the option pricing model stays the same, but the S, which was 100 million, has now dropped to 50 million. So I plug the numbers in the option pricing model. 75.94, 24.06. Let's see what the value works out to. The value of the equity drops to 30.44 million. It drops by 45.5 million, but by only 45.5 million. Could have been 50, so be happy. The value of the debt drops by 4.5 million. What else has changed? What was the probability of default before this happened? Remember, it's 1 minus ND2, it was 37%. Now it's almost 56%. No surprises there. If half the firm disappears, there's a greater chance that you will now default. So that jumps up. So as the value of the firm drops, equity value drops, but so does the debt value. You think, so what? That's pretty intuitive. I had to figure that out myself. Here's what I started doing. I started lowering the value of the firm, 50 to 40, 40 to 30, 30 to 20, 20 to 10. You know what I wanted to find out is, when does equity become worthless? How deep down into the ground do I have to go for equity to become worthless? And what I discovered is equity is an incredibly stubborn instrument. It hangs in there. I lowered the value of the firm to 5 million. I still owed 80 million, but the equity hung in there. What's keeping the equity afloat? Obviously, if you called in anybody, they'd look at this company and say, this is a basket case company. Nobody will buy these shares. But guess what? They're still buying the shares. Why are they buying these shares? First, let's get rid of all the reasons you're not. Are you buying this for the cash flows? Not unless you like large negative cash flows, right? Are you buying for the dividends? What dividends? You're buying it because you hope that something good will happen. Then you pray that something good will happen. You're buying it for the same reasons you buy deep out of the money options. Let me ask you a question. What happens to most of the deep out of the money options that people buy? They end up in the trash can. So why do people buy them? Not because they're crazy, but when they pay off, what kind of returns do you get? That 25 cents you paid for the deep out of the money option can become $2.50. This is one of the few chances in your life you're going to make 900% returns. It gave me an entirely new perspective on what bankruptcy means. I used to think bankruptcy meant that the value of your assets was less than the value of your liabilities. That's why I always taught bankruptcy in traditional classes. This gives me a different perspective on it. In fact, my daughter is now 21, kind of got this when she was 2. She's a financial genius. This she got somehow, accidentally, I think. She was, this was actually a summer, maybe around her 3rd birthday. And I used to play Monopoly with my 2 older sons. My daughter insisted on joining in. Very tiny person, very persistent. So finally I said, Kendra, you can join in. And after about 2 games, I had to banish her, because she did things like take $200 from the bank, whether she was on Go, passing Go, looking at Go. So basically, she was stealing from the bank, putting up hotels and properties that didn't belong to her, and charging people, saying, I put a hotel there, you got to pay me. So finally I said, Kendra, you're banished. She was furious. She starts walking around and saying, you're bankrupt, you're bankrupt, you're bankrupt. I'm very impressed, the 3-year-old using the word bankrupt. I said, Kendra, what does bankrupt mean? Expecting an answer like the value of your assets is less than the value of your outstanding liabilities. She says, bankrupt means you don't get to play the game anymore. You know what? That's a perfect definition of bankruptcy. Because as long as you get to play the game, you're not quite bankrupt. Because something good can happen. That's what's keeping this game afloat here, is you have 10 years where you can hope and pray and hope and pray and hope and pray. 9 times out of 10, 95 times out of 100, those hopes and prayers will be in vain, but maybe that other 5% you're going to be able to. I remember in Continental in 1992, Continental Airlines was trading at $1 per share. It was a company that was technically bankrupt. But if you bought it at $1, 4 years later, that stock was trading at $52 per share. Remember Las Vegas Sands trading at $8.15? It's now trading at $65. Because that's what happens when companies are, when you have a lot of debt, because all you need is small swings in the value of your operating assets, and very quickly your equity can go from nothing to a very large value, at least in percentage terms. And that's the game you're playing. So that's the first thing to remember is when you are looking at equity in a deeply distressed firm, the way you think about risk, in a sense, has to shift. You don't want to own equity in a deeply distressed, stable company. I'm not even sure what that means. I lost $200 million. I can guarantee you I can keep losing $200 million every year for the next 50 years. Who wants that? If you're in a scenario where there's deep distress, variance becomes your ally, risk becomes your ally, because that's the only way your equity is going to be worth money. Any questions on equity as an option? I'm going to take a second scenario so you can see this play out. So let's go back to the original scenario. Value of equity was 75.94, value of the debt was 24.06. Let's assume that I now come to the equity investors. You guys are out of the game. As lenders, you don't get to play any role in this. I come to you with a project. What kind of project? This is a negative net present value project. I'm a project salesman. What's your first reaction? You remember your corporate finance class. Get out of here. I say, no, it's not just a negative net present value. It's a really risky negative net present value project. This is going from bad to worse, right? But as an equity investor in a deeply distressed company, do you see how you're pulled in two directions? If you take the negative net present value project, you know the value of your firm is going to drop by $2 million. That's the bad news. What's the good news? By taking this really risky project, you could make your company riskier than it used to be. And remember, your equity has option-like characteristics. Let's see how this plays out. So let's assume by taking this project, the net present value is minus $2 million. So the value of the firm drops to $98 million. That's the bad news. But the variance jumps from 0.16 to 0.25 because you made your company riskier. This is a bad negative net present value project. I'm going to show you some corporate finance valuation magic. By taking a bad negative net present value project, here's how much you hurt yourself as equity investors. Your value of equity went from $75.94 million to $77.71 million. You actually increased the value of your equity by taking a bad negative net present value project. And guess who paid for it? You guys did. So what's the implication? If you're a banker lending to a deeply distressed company, what's the one thing you can never do? Let the equity investors make all the decisions because they're going to rip you off. Not because they're bad people, but because maybe because they're bad people, but that's kind of irrelevant. But because there's a conflict of interest. What's good for you and what's good for you doesn't converge. You can't say they'll think about the good projects. They don't have to. The wealth transfer actually can be much greater than what you will lose by taking a bad project, which is part of the reason when bankers lend to distressed firms, they need to have a role in how the company is run. You cannot let projects, you almost need veto power every big decision, because if I don't have veto power, I'm going to get hurt as a lender. So it's another way of thinking about, when we talked about debt and equity in corporate finance, we talked about the conflict of interest. This is how it plays out in an option pricing world. Okay. Let's take a third scenario. So one by one, I'm knocking out things we said are truths in corporate finance. We're saying, okay, so positive net present value projects should be taken. Well, sometimes you'll take negative net present value projects if equity becomes an option. Now let's take another standard thing you're told in corporate finance. Let's assume that I'll revert back to the original firm, that I come to you with an acquisition of another firm. The firm is worth $150 million, and you're going to be able to buy it at fair value. So what happens when you buy a company at fair value? Nothing should happen, right? Like taking a zero net present value project. Let's add to this then. Okay? Let's assume that the value of the firm you're buying, or the firm that you're buying, has $50 million in debt, has also got a zero coupon bond, 10-year zero coupon bond, and the standard deviation in firm value for the second firm is 50%. But the firm is in a different business. In fact, the correlation between the two firms is 0.4. Which means that sometimes when the first firm does well, the second firm does badly. So this is the essence of diversification, right? Different business. Let's see what acquiring this firm. This is a fair value acquisition. You bought it at $150 million. Let's see how it plays out for the equity investors and lenders. Because these two firms are in different businesses, the variance of the combined firm has to use that standard. Remember how when you start a finance class, they take a two-asset portfolio and they compute the variance in that portfolio. So in case you remember that, the weight squared times the variance of the first asset, weight squared times the variance of the second asset, plus the third term is the covariance term. In this case, the covariance term captures the 0.4 correlation. The variance in the combined firm's value is 0.154. You're saying, so what? The variance of the standalone first firm was 0.16. The variance of the standalone second firm was 0.25. The variance of the combined firm is actually lower than the variance of the two individual firms. And that's typically what happens in a conglomerate merger. You're saying, so what? You're the equity investors, right? It's a fair value acquisition, but by doing the acquisition, what's happened to the variance? It's actually gone down. When I plug the numbers in and value the equity in the firm as an option, the value that I get for the option is $207.43 million. You've effectively lost $3 million in value after the acquisition, even though it was a fair value acquisition. And think of the intuition as to what happened here. You had two companies with lenders to both companies. The two companies were risky. You set interest rates based on the risk of the two companies. You combine the two companies, you've created a safe company, but the lenders still get the interest rates that were set to the two risky companies. So let me ask you a question. If you're the equity investor, how do you claw some of the money back? What do you have to do after the acquisition? Or even before the acquisition, what are some of the things you can do to counter this loss of value? Because this is going to happen every single time you have a merger with another company in another business. How do you get some of the value back? First, at the time of the acquisition, were you forced to stay with the existing debt ratio? You're going to become a safer firm. You could actually borrow more money. So the first way you can claw the money back is by using more debt on acquisitions. The second is, after the acquisition, you can go to the lenders and ask to renegotiate. Pay off the old debt, replace it with new debt at a lower interest rate. The $3 million will come back to you. But if all you do is keep acquiring firms and don't do any of the counter stuff, you're going to end up leaking value as equity investors each time you do an acquisition. So now let's talk about how you would actually use this on a company like Bombardier. Obviously, the example I used was very artificial. I gave you the value of the firm, I gave you the debt, I made it a nice zero coupon bond. But in the real world, if you're looking at a distressed company, whether it's Valiant or a Bombardier, the debt is not going to take the form of one nice zero coupon bond. There are going to be dozens of debt offerings with different interest rates. So the question is, how do you actually end up using this on a real company? Because real companies don't have the features that I had for the artificial example. So I'm going to cheat. I'm going to actually take a real company and make it look like my artificial company. And here's how I'm going to do it. For the value of the firm, I know I'm not going to be given a $100 million number, but I can estimate the value by doing one of two things. I can do a DCF of the company. You did a DCF for the operating assets. That DCF becomes the equivalent of the S in the model. That is the value of the assets that you get. In fact, if you want to be conservative, you can just take a DCF without any growth components built in, just assets in place, even apply liquidity discount to it. Say, look, I have to liquidate, I'll lose 15% of the value. That becomes the S in the model. If your company can be broken up into pieces, in the case of Valiant, let's assume you can sell off Bausch & Lomb separately, Selig separately. You can value the sum of the pieces in liquidation. That can be used as the S. So that becomes the starting point, is coming up with what you would get if you liquidated the company today. Let's move on to the variance in firm value. This is a variance in firm value, not equity value. There are a couple of ways you can get that. If you have lots of time on your hands, you can actually take the stock price for the company and the bond price. Valiant has both stocks and bonds outstanding. Bombardier has stocks and bonds outstanding. You can look at the standard deviation in stock prices, the standard deviation in bond prices, because they're both traded. And you can try to compute a standard deviation in firm value, again using the two-asset portfolio, acting as if you have the equity and the debt in the company. So equity might be 20%, debt might be 80%. You compute the variance in firm value. I almost never do this. It's too much work. So here's the other way you can do it. You have a troubled pharmaceutical company, right? Or a troubled aerospace company. Rather than try to compute the standard deviation from scratch, I'm going to go look up the standard deviations of healthy pharmaceutical companies and healthy aerospace companies. So just as I bottom up betas, I bottom up standard deviations that I've computed by sector. So I'm going to use that standard deviation as my standard deviation when I value the option. So those of you who actually have companies that fit this And there'll be only about 15 companies or 20 companies in this entire class that actually make it through to meet this requirement. If you have to get a standard deviation, just go look it up for the sector. Third, I need a value for the debt, and I know I'm not going to be looking at 190 coupon bond. So here's what I'm going to do. I'm going to take all the debt outstanding that this company has and add it all up, including the interest payments. I'm going to come up with this cumulative value of everything I have to pay the lenders. And I'm going to call that the face value of my bond. And then I'm going to take the durations of each of these debt and take a weighted average duration. And I'm going to see what I'm trying to do. I'm trying to replace all this messy debt with one equivalent zero coupon bond. I know it's cheating, but I know the alternative is to have an option pricing model that's incredibly messy to deal with. So I'm going to take all of your debt and replace with one nice zero coupon bond. Once I do that, I've got something that looks exactly like my hypothetical company. I can value the option of that company. Questions? So let's try this. The company I'm going to use is that hole in the ground where cash goes in but never comes out, called the Eurotunnel. When it was built, all these ambitions of how much money it was going to make the British government and the French government, it's never made money. So in 1997, I did a DCF valuation of Eurotunnel. And the reason I picked Eurotunnel as the option I'm going to try to value is in 1997, Eurotunnel had operating losses of 56 million and a net loss of 685 million pounds. So it's clearly losing a lot of money. Its book equity had turned negative, which tells you what? It's been losing money for a long time. The company had an incredible amount of debt, almost 9 billion pounds in debt, from all kinds of sources, short-term, medium-term, long-term, corporate bonds, bank debt. I just broke them down by maturity from short-term to longer. That's how much debt they had in each category. That's a duration of the debt. And if you're too lazy to compute duration, just use the maturity. It works pretty well. The weighted average duration of the debt was about 10.9 years. The total debt outstanding, including interest payments, was 8.9 billion pounds. So here's what I'm going to act like Eurotunnel has. It has one huge zero coupon bond with an $8.9 billion face value and 11-year duration. As I said, it's cheating because they really don't have that, but it's going to make my life easier. So first step is, I wanted to see what would happen if I liquidated Eurotunnel right away. So I did a traditional DCF valuation, and the value that I got for Eurotunnel as a going concern was 2.3 billion pounds. How much debt do they owe? Almost 9 billion pounds. This is a deep, deep, deep out of the money option. And to get that 2.3 billion pounds, I actually made some pretty optimistic assumptions about margins improving and revenue growth picking up. But that's DCF value becomes the S in the model. So let's see what the other variable in here. I need a variance in that value. Unfortunately, there weren't too many publicly traded companies in this space in 97. Today I might use some big infrastructure companies to do it. So at that time I actually used the stock price and the bond price, and Eurotunnel had both stocks and bonds outstanding. It was about 85% debt, 15% equity. The standard deviation in its stock was 41%, and the standard deviation in its bonds was 17%. The stocks and the bonds moved together with a correlation of 0.5. So again, I'm using the two-asset portfolio. The variance that I get in Eurotunnel's firm value is 0.0335. And this is the number I would replace with an industry average if I'd been able to find it, but I didn't have it at that time. I have everything I need. I have the value of the company, I have the face value of the debt, I have the variance in value. I have 11 years to play this game. If you plug the numbers in, 2.3 billion pounds in S, 8.9 billion is K, 10.93 years variance, what I get is N of D1 and N of D2 are right here. Take a look at N of D2. What's the probability that Eurotunnel will not make it? 92.5%. No surprise. If the value of your assets is 2.3 billion, you owe 9 billion. That makes sense. But here's the most fascinating output. This is a basket case company. This is an absolute disaster. But look at the value of the equity. It still hangs in there, 122 million pounds. Why? Because there's optionality there. Most of the time you're going to end up losing the 122 million pounds, but you can see how equity will hang in there, even if a company is deeply distressed. In fact, the interest rate I get for the debt with that calculation is 13.65%, which is a huge spread, 7.65% over the risk-free rate. Again, no surprise. There's a huge chance you will not make it. So it's a different perspective on equity. It basically looks at equity in a deeply distressed company and says, this is an option. I've got to treat it as an option. So let's say you decide to play this game, right? You decide that you're going to buy equity in deeply distressed companies. You're a vulture investor. Isn't that what they do? Buy equity in deeply distressed companies. So I'm going to ask you to look for your best opportunity. So you go into Capital IQ, and I'm going to item by item. You tell me what you're looking for. First, you look for debt ratios. You want a high debt ratio or a low debt ratio? You're looking for an option to liquidate. You want the highest debt, because if there's no debt, the optionality disappears. What's the option to liquidate? So you want a high debt ratio. Mature companies or growth companies? The problem with growth companies, when you liquidate, you're not going to be given all that growth stuff. So you want to come up with mature companies with most of the market value is already in assets in place. So you want mature companies with high liquidation value, with high variance or low variance in their value? High variance. So you basically want mature companies with a lot of debt with high variance. Final question, you look at the debt. They have a lot of debt. Do you want that debt to be short-term debt or long-term debt? In fact, Capital IQ gives you an average maturity for the debt. Do you want to screen for low maturity or high maturity? You want high maturity because you want a lot of time to play the game. Try it out. Take companies with a lot of debt, which have high variance in value, and as long-term as you can make the debt to be, you essentially will have equity behaving like an option. So as you look within your groups as to whether this applies, don't try to force it on a company. So if you have a company with a 10% debt ratio, it's not going to work. In fact, the trigger for this for me is if your market debt ratio, debt to capital, is less than 50%, don't even bother. Your option value is going to be very close to your DCF value. But once it starts exceeding 50%, the debt ratio, then you have at least the potential for optionality. So start thinking about what's the value of equity as an option. And for those of you who are valuing distressed companies like Bombardier or Valiant, this might be your chance to bring the equity value above zero. It might not make your stock still a good investment, but it gives you a chance to see why people might be willing to pay for the stock, thinking of it as an option. In fact, at the depths of the Brazilian crisis, when I went back and bought Vale and Petrobras, I'll make a confession, I wasn't buying them as going concerns. I was buying them for the optionality. Right? And the thing is, when you buy it for an optionality, you actually want it to become a going concern again, because that's what makes your option so valuable. And what made for optionality in both those cases were huge amounts of debt on a natural resource company. Right? The variance in the value comes from the net. So think about how that plays out in distress investing, and you might see some potential for applying this in investing. So let's close off this entire option pricing discussion. There are lots of options. They're everywhere. And so if you're not careful, you're going to be adding option premiums for all kinds of stuff. Most of those options you should ignore because they have no significant economic value. And the test for that is, how exclusive am I? And the answer is not that exclusive, the value of the option will drop off. And the real value to me from using option price or thinking about option pricing is not actually plugging into an option pricing model and coming up with a value. It's a change in mindset that goes when you think about something as an option. Change in mindset what? Remember, risk goes from being a bad thing to a good thing. And that is something that I think we need to recognize, is that's what's driving the value of these options. So I think this is going to become a bigger part of investing simply because the world is getting more uncertain. There are more things happening under the surface, and the optionality is rising to the surface in many companies. Okay? Any questions about options? Yes?
Why wouldn't you have the variance around the cash flows from the underlying assets?
Oh, that's what a variance in firm value is always the underlying asset. It's not variance. That's why I don't use variance in equity value. It would be so much easier for me if I could use variance in equity value, but I need variance in firm value. Right? So if you go back, if you look at the variance that I used, I started with the equity value standard deviation of 41%, but that's not what I used. I used the weighted average because I'm trying to get a variance in firm value. So if you look at the table that I have by sector, I do give you a variance in equity value. That was an easy number, but I also give you a variance in firm value, which is trying to capture the variance in cash flows. If you get really ambitious, this is where having crystal ball can help you, right? Because if you have a DCF valuation on Bombardier, you can do a crystal ball Monte Carlo simulation. You'd come up with a distribution of values. Right? So maybe that's the next thing I should do in value. Just value it as an option, because if we're going to value it as an option, might as well bring in the distribution and see how the option value plays out across different outcomes in the distribution. Okay, so here's what you're going to get between now and Wednesday. Wednesday, we're going to actually take perhaps the most depressing aspect of corporate finance, which is acquisitions. Depressing because so many companies destroy so much value through the acquisition process. We'll have a central mission, and the central mission is as follows. How come people don't seem to learn from their mistakes in this process? How come you see the same mistakes repeated over and over again? There must be something screwed up in the process, and I'm going to focus specifically in the acquisition part of the process and talk about what do people do wrong and continue to do wrong. So I'm going to send you a little pre-class set of questions, like 7 questions. They're not difficult, just try your best to kind of work through them. Because when we do it on Wednesday, those are the questions around which I'm going to build the entire discussion, because those are the questions where if you get them wrong, your valuations are going to be off. I don't think I've ever finished ahead of time. You can learn. That's all I need. So maybe next class I should finish at 10:35. I'll get even more applause. You know?
I was thinking if the value of the real estate current price, that's the strike price. If the value of the Blueberry Farm.
No, that's because it doesn't take care of itself. So S, when you put a standard deviation on it, you're saying the value of the Blueberry Farm could go up or down. The strike price becomes the value of the real estate. So basically, once the value becomes up. So the downside that you capture in there isn't the S.
Okay, perfect. So either way I look at this.
I wanted to check, Sam, I don't know if this is a good moment or not. I understand what you did. I saw the solutions. But what I did was, based on the revenue, I looked at the allocation of the SPM cost.
You can't apply that, though, because when you're applying 7 times multiple to the corporate expenses, the corporate expenses are almost a fixed expense. Right? So basically, it's going to affect the growth. So you have to separate it. That's why when we did the United Technologies DCF, we kept corporate expenses explicitly out, because the very fact that they're separated means that it's tough time allocated. Because if I were able to allocate them that easily, there would be no corporate expenses, right? It's whatever you can't allocate that ends up being called corporate expenses. Because what they do is any expenses that can be traced to what the divisions do, you're going to allocate. But then you're left with this lump sum, like the CEO salary. Well, you don't know how much time the guy spends each day on it. So the nature of corporate expenses is they're kept separate because they can't be allocated. So I saw what you did, which is that you allocate them based on revenues. But that's why I gave you the cost of capital and the growth rate, right? Because it's the one item where you don't need any of the other stuff to actually do a DCF on that part.
And in the cost of capital, you're taking into consideration which one of these is.
No, because both these businesses are helped. The corporate expense, by definition, is feeding. That's why I gave the cost of capital to the whole company, right? Because the expenses are to the whole company. So the very fact that it's separated out means it's not easily allocated. And because it's not easily allocated, you can't base it on revenue. Well, that is
So this wouldn't be like a rule of thumb that I could use.
No, generally don't do that, because it's going to get you into trouble, because corporate expenses don't have the same risk characteristics as the individual businesses.
Okay.
Okay?
Thank you, Professor.
Anyway, I got 2 questions. First is, my DCF model I do right now, the regression that I'm going to use, I only have 15 comparable firms tonight. I found 15 most similar ones. And you said that for every 10, you should only add 1.
So you're stuck with one variable.
I only have just 1.
15, you can't go over one. Your regression is getting incredibly
I had 3,
unstable.
so only 1. So use, okay, I'll do individual.
Either that or expand your sample to bring companies less like yours, right?
Or that.
I mean, that's the choice you have. You can go with companies just like yours, smaller sample, one variable, or you can let companies be different on more dimensions and try to control for them with more variables, right? So you can go to 40 companies, you can have 3 variables. and let the variables control for what you think of this. So you can have lower growth companies, higher growth companies, smaller. So you can throw in variables in there to capture differences across the 40. So that's the advantage of running the regression, is you can have a more diverse sample and more variables in there. But it's your choice. If you run a 15 in one regression, I'm okay with one variable.
And the next one is, I did my trailing 12-month revenue on your model, and so looking at their 10Ks the last 3 years, they have revenue go up to 40%.
Right.
But on the trailing 12-month way it's done, it's 7% growth, because I only had their fiscal year ended in June, and so it's been 3 months since then. So putting that into my model, it looks very weird. Should I just do my 2016 10K and leave it that as my most recent annual revenue?
What's changing when you go to the trailing 12 months? Just the growth rate?
Yeah, it's 7%
But
because
that's your choice still. You're not stuck with using past growth rates. So I mean, you can so if you have a good reason why the growth dropped, if there's a reason the growth dropped.
Oh no, it has. No, it's just based on how the model is that
The model doesn't read your growth rate though. It allows you to input the growth
I
rate.
can just put in 40% of the model.
Yeah, or 80% or 150%.
Because on an annual basis, they have grown 40%.
So
Look at 10K information.
But then what you're telling me is the last 12 months were an aberration, that the low growth that happened. So look to see why the growth dropped so dramatically over the last 12 months. Right. Because if there's something real going on, you go back to the old growth rate, you're going to overvalue the company, right? But if you can find a specific reason, maybe the labor force went on strike for 2 months and that's why they couldn't sell stuff. So you want to find out what happened to the growth rate and not treat it as it's a number. I'm just going to go back to the old growth rate, because if something real happened to bring the growth rate down, you want to make sure you reflect that in the valuation. But the growth rate is still is under your control. You can enter the old growth rate if you want to. You can enter
Just the annual
number in the
growth rate
middle.
of what it is on the 10K. Thank you.
Anyway.
I have the problem about right now my company that I want to look is a refinery and petrochemical company. So is
Which
not,
one is it?
Is a company in Thailand,
Right.
and then they don't have like a reserve. They have like they are totally the refinery and the petrochemical plant. So I have problem about the option right now. So I'm not sure that
I don't think there might be an option. If you're all your refinery, then you don't have
Yeah.
reserves. You don't benefit from it. In fact, your option might cut in the opposite direction, especially if they're required to sell gas at a controlled price. So it's not an oil company in that sense. So there's no option. You don't benefit from higher oil prices. You actually have hurt, because oil to you is an input. You have to buy it from oil companies, right?
So I'm just thinking like the last one that you talk about, like the leverage one, and then if I value it in terms of option,
There's
You
no,
should-
you have non-developed reserves, no. So there's no option. So just a traditional DCF. It's just basically a processing company. It processes oil. So basically, as a processing company, there is no option value.
but I think like they have like the high leverage as well, because they just like revamp the whole refinery and the petrochemical plant. So I just think like the debt ratio is might a bit higher than the normal.
Oh, you're talking about the oil as an option, or equity, distressed equity as an option? Which option are you talking about? Let's be specific.
Let's say the equity one.
Yeah, that could work, because if you have enough debt, the equity, that's got nothing to do with oil prices. That comes to the fact that your earnings are variable, and you have a lot of debt. Then there is an equity component. There's an option component to your equity. So that will work. You know, whether you're a refinery, whether you're a steel company, or whether you're a retailer.
Okay.
Right? That has nothing to do. So there's I thought you were talking about the other option, oil, the undeveloped reserves. That option doesn't exist, but the distressed equity option can.
Because I just think like, because the reserve one is I cannot apply that for sure, but I'm just thinking like I can
You can
apply like the
equity.
equity.
That's a separate option.
Okay. Okay. That's it.
So what happened in your group? Are you still working with your group?
Yeah, still in my group. Every time that you talk about option, I have the feeling that options it's more like a price and then a value.
See, no, there is a value to an option. What you're doing is you're saying, look, I have to take an expected value per company. And what happens with options is, when you do the decision tree and you get the positive outcomes, if your outcomes are positive enough, there might be other things you can potentially do.
Where there is value.
Exactly. Right? That's where the option. So there is a real value to options, but you have to show me that if those good outcomes happen, that you and only you can take advantage of the extra positive outcomes. Exactly.
In those cases, that's okay. I'm gonna do the option, but I was thinking as well. I can. I mean, the possibility to have a higher production in the future because of the oil prices. I can represent that in the future revenues as well.
Not unless you want to take a point of view about oil prices, right? So because let's suppose right now you know the oil price is $48, right? When you do your valuation, right, it's very dangerous to take a point of view about oil. So you basically, when you think about future oil prices, you're building off the current oil price. Right? You can use the forward oil price, but it's going to be very closely connected to the current oil price because you can store and deliver. So your oil prices that you build in for your expected cash flows are built on the presumption that it's $48 growing at 2% a year or whatever the forward market is. What you're not capturing is oil prices could go back to 120, right? All you need is one big Saudi Arabia has some kind of internal revolution, the kingdom falls, oil prices are going to go to 150. That's so on an expected value basis, the market doesn't think it's going to happen. You don't think it's going to happen, but it could happen. That's the optionality that you're not capturing. That oil prices go to 150, all of a sudden those undeveloped reserves that look non-viable to you suddenly become viable, and that's the option value. You can't build in the expected cash flows because it's really not an expected outcome.
And I cannot use like a probability as you use it for bankruptcy firms. I mean, we have the probability for bankruptcy.
You have to do the full decision tree. Remember how I showed you? So if you're willing to do a decision tree that captures every possible scenario, remember the scenarios are not just
I'm
reported.
just trying to run away from option with the DCF, but using the DCF, I have like two
You'd
DCFs.
have to capture all the scenarios, not just now. And this is, I think, the tough part. You'd have to capture the scenarios next year, 2 years. So it's basically not one set of because today you can say, what are my scenarios for the oil price for the next year? But this is actually will repeat itself each year in your valuation. And it gets messier and messier and messier, and that's why you go to the option pricing model, because your decision tree gets to be really dense. So it can be done, it just gets overwhelming because there's so many layers of
Because it's going to affect the investments, revenue,
and yeah, so it's and that's why you draw behind finance. So look, I'm going to do traditional DCF with an expected value, and then I'm going to use the option pricing. Or you can do the Monte Carlo simulations, right, which is another way of bringing in the scenarios, but again, it's not going to fully capture those. I mean, you know,